The 2008 housing crash here in America still cast a long shadow over many minds. Now, back then, the bubble in the housing market burst when it led to widespread foreclosures and a significant drop in home prices. Now, perhaps another price will decrease housing prices, making it finally affordable again, so you can start having your happy life, right? But wait, you certainly don't want the housing market to crash again, and here's exactly why, and I'm going to prove it to you in a minute. Now, if you watch this all the way to the very end, I'm going to share with you something that's absolutely life-changing when it comes to buying and selling real estate of any kind here in the United States. But first, a repeat of 2008 might not make houses affordable again for you. Another housing market meltdown might make things worse for you as a home buyer. I'm Jerry Pincus, your real estate expert, and today we're investigating possible scenarios in the housing market crash in the near future and examining potential impact on housing affordability. Now, in the past 20 years, my team has helped over 2,000 people successfully move, and I'm here to help you to avoid those pitfalls that are costly. Now, first off, if the housing market crashes, it's not going to happen like it did the last time, and it doesn't happen every time. Money will dry up, and loans will be harder to find, even if you buy it as a home buyer. Banks become much more cautious in raising their credit scores and their requirements, demanding more higher minimum scores just to qualify for a mortgage. Now, what this means is, even with a steady job, your dream home might only fit your credit score, which meets these new strict guidelines. Additionally, lenders might raise the down payment minimums or other requirements for larger upfront investment for potential buyers. Lenders also become more cautious in reviewing your overall financial health, and they make it more difficult to get a loan. This happened the last time, and it'll happen again in the future. A market crash could also put your job into uncertainty and your economy and any income that you may have. This is because a housing market crash of any kind is often accompanied by an economic instability in our country. So this uncertainty in the broader economy will make it harder for lenders, and it makes it harder for the population as well, because people are going to be more cautious when there's bad news. So with stricter loan terms, potentially unstable jobs, potentially disruptions in income, qualifying for a mortgage in a post-crash environment can significantly challenge and change the entire dynamics for everyone. How about if you're paying 100% cash? But even if you pay 100% in cash, the housing market crash will lead to a broader economic recession for the country. Now, the current market, the U.S. Federal Reserve, and the central bank uses various tools to manage interest rates. Let me just let you know, guys, that the U.S. government has a huge debt of $34 trillion and keeps spending excessive income. Now, when the market dips or crashes, there are concerns about the government debt. Economic downturns can strain government finances and people's finances, making it more challenging to manage this debt. Now, at some point, the Federal Reserve needs to raise interest rates even further just to stabilize the economy. And this will eventually raise interest rates for you, which can have a significant impact on mortgage affordability and the return on your investment. Because you could have a rental income property that may be affected, and you have renters that are affected as well. Look, it's the interest rate that you pay on your mortgage directly affects your monthly mortgage payment. Now, with an interest rate increase, this could mean that it might take higher monthly payment for you. Even with much lower home prices, higher interest rates can make monthly payments less manageable and limit the number of buyers who can actually qualify for a mortgage. On the other hand, a market crash might likely decrease the overall economic activity. This would include anybody who's renting, and it can affect anybody on any level, because this can impact job security and potential decreases in wages. With lower wages and potentially higher mortgage payments due to increased interest rates, achieving homeownership in a post-crash environment will become even more challenging. Also, because prices will drop, you may never be able to time the market perfectly, and many existing homeowners might need more time to sell their properties in a crash scenario. Homeowners during that time, particularly those who have secured mortgages with especially low interest rates, they may choose to hold on to their property even longer if prices are dropping. Why? Because these homeowners, the financial benefit of holding on to their current low interest rate mortgages could outweigh the potential decrease in the selling price. And when this happens, they may choose to put their houses into a rental position rather than selling them for a loss. At least they would generate some income for the property while they're waiting for the market to recover. When this happens, renters can negotiate lower rents at more favorable lease terms and shorter lease commitments, or even pet-friendly policies. Anything to get that thing rented, right? And then many people will say, well, there goes the neighborhood. With cheaper options all around your house, even if you decide to rent your home, you may be forced to settle for less. Now, institutional investors in such cases get a massive advantage because they have a whole chunk of a neighborhood that they can control, and they can choose to keep the prices higher in an area, and they will. But a single house owner, you won't get that privilege. But wait, there's more. Increased rental property numbers means fewer homes available to buy. And building new homes is an option, but only a few builders will choose to do so. Why? Number one, the cost of the land itself is a significant consideration for builders, because land prices are generally less unstable than home sale prices, and they might not decline proportionally to the housing market. And this creates what we call a floor price in new construction, preventing even noticeable drops in new home prices, because there's set costs for building permits, building materials, and some labor costs. And that means even if an existing home prices drop, the underlying cost of that land, the materials, the permits, can still be a significant expense for builders. And builders will only be able to build affordable new homes if the costs are actually low. And second, as we've seen in the past, the cost of new building materials will go up even higher due to inflation over time. It's called the compound effect. Materials like lumber, concrete, and other essential materials still need to be made affordable. And we've seen some trades, labor costs increase even in a down market. Additionally, as a housing market dips, a risk can be for economic stability. And this can discourage builders from starting any kind of new construction projects. So with fewer new homes being built, the overall housing supply is growing. This can add even further downward pressure on house prices, even for existing homes. So while a housing market crash might seem like an increase in homes for sale, it might seem like a good idea and a good time to jump in just to scoop up that deal, the truth is, whenever this has happened in the past, this is only temporary, and those affordability of those houses, especially in new construction, will not be as affordable as some might be hoping for. So a real estate market crash is what you're looking for. I wish you success. Here's the truth. The real money is being made daily, every single day, by average homeowners and the true investors, not the speculators, who took the long-term approach to real estate. They're not speculating, they didn't speculate, and they're not willing to gamble. They're not gambling. They're not waiting for the perfect market timing. They know the compound effect. They know that when it comes to being the best choice of a return over time, they always point to the old pillar of the American dream. They know that real estate is the best place to invest their money when it comes to personal finance and getting ahead in life. And stocks, they rank second. Now, if I had waited to time the market every single time, I would have never bought those parcels of land back in the 1990s, and those houses back in the 1980s, and the income-producing properties in the 2000s, or even last year, or the commercial real estate properties. I would never have had the income produced from those properties to pay them off, and they would continue to generate income into the future if I had waited to time the market. I probably would not be here today giving you this message, and you would not be seeing any of my videos here on this channel. This could be why more average, common, everyday people have made money and been able to get ahead in life here in the United States. The fact is, 90% of all millionaires have done so by buying and owning real estate. The fact is, more money has been made in real estate than all industry investments combined. Now just remember the compound effect. It's the small, seemingly insignificant things that we do on a daily basis, compounded over time to bring us our significant results. And you can harness this compound effect and create a success in your life as well. You can still find the deal of the decade because it happens about once a week. You just need to know where to look, where to find them, and what to stay away from. And not everything is on your Google search that you call research. That's a Google search. Not everything is online. Hiring the right real estate expert who knows the market and can find it can make all the difference. Now, if you found any of this video helpful, make sure you share this with your family and friends who have been on their knees praying for a housing bubble to burst. Because if you didn't already know, my name is Jerry with Jerry Pincus Real Estate Experts. My real estate team is here to help you find your hidden gem and to help you avoid those pitfalls that are costly. So if you're thinking of selling a house anywhere in the United States, give us a call at 843-839-9870. And until next time, stay happy, stay educated, and I'll talk to you soon. Take care.